commonly buyers want to see several years of financial records, tax documents, accounts, cash flow, and sales before they feel confident. So this is why sellers need to be organized before they go to market. There's no point selling something that's in a mess
Yeah.
and trying to fix it on the go. Much better to fix it before you or before you go to market, definitely before you go see the lawyers.
One thing very important is that if the numbers are messy, buyers either walk away or the business will be discounted the price heavily. So that's what I always worked with the accountant by understanding the numbers, including the structure and balance sheet, profit loss properly before present the financials to the
Yeah.
buyers.
Due diligence is done in different ways. It's not just a buyer's thing; it's a vendor's thing as well. Both sides need to make sure that they understand who they're also entering. Because entering into a deal, for example, as a seller with a buyer who can't complete or has no assets behind them, was going to pull out, could leave the vendor with as much of a problem or losing other offers or deals that were on the table. So due diligence is important from both perspectives.
Yes, so to me, for the buyer side, in order to protect my vendor, because every time they present the buyers for the lease transfer to the landlords, the landlord normally will check the buyer's financial asset liability statement, and also whether for the vendor side, I need to make sure the buyer will have the ability to pay for the vendor at the settlement. So checking the financial situation of the buyers are also part of my job.
Now, I just want to talk about when deals usually wobble. This is probably the most useful part for people listening. Where do deals usually start falling apart from our experience in the industry in knowing where things go wrong, from things we've seen in the past and other transactions that I've observed, legal cases and so forth I've been involved in coming from a litigation perspective, trying to clean up an issue that I haven't necessarily been involved in the transaction, but I see and read, legal cases. I understand where things go wrong from a legal perspective. What about yourself, Judy, in industry? What have you seen where things usually fall apart?
Yeah, I think most deals do not fall apart for big reason. It's usually a combination of small issues. For example, communication. There's also managing emotions. Communication is the key. So common ones are unrealistic pricing. That's when it comes to the preparation before listing on the market. So buyers are not being able to secure finance, or issues coming up during the due diligence. We also see delays when seller do not provide information quickly. They might be going on holiday, or for some reasons they don't, the response after 1 or 2 weeks when the buyers is waiting and they lose patience, or when decisions become emotional. And once momentum slows, it's very hard to recover the deal.
I think, from the legal side, what I've seen in the past, observing other situations or coming in usually to try and clean it up from a commercial litigation perspective, having to go to court, is usually things like the heads of agreement are too vague. And sometimes I don't necessarily agree that every transaction should have a heads of agreement. I think some should just go straight to a contract. Depends on the deal. It needs to be assessed case by case. But there's a dispute over stock value, whether stock is valuable, working capital, or handover. Bad restraint drafting in a contract, unclear warranties, indemnities is a real bad area because people will try to avoid what they can, and it's up to your lawyer to make sure that it's watertight as best as can be done. It's still negotiated because there's two sides to the contract, so you can't dictate all the terms, but you can try and put in as much as you can to protect your client. Confusion over whether it is an asset sale or a share sale. Now, that should never happen, and you should be always using the right type of document, and it should be structured correctly. That should be clearly articulated from the beginning. And this happens with rapid sales and so forth, where the clients or the people involved want to sell quickly or buy quickly. That's a matter of managing the client. It's not easy. Everyone's different personalities, but you have to follow a set of policies and procedures as a legal advisor, and this is what you follow. And if the client doesn't want to work with you in your system, then that is not the right client for you. And sometimes you
Yeah,
just need to say no.
That's right. The structure around the deal is just as important as the price. The lease can directly impact the value. Staff continuity will sometimes matters, and the handover is part of what the buyer is actually paying for. I mean, the transition period. If the business doesn't feel transferable properly, it is very difficult to justify the price. So at the end of the day, my understanding is that we are dealing with people, and a good organization culture environment is very important. So when it comes to the employee or staff, during the transition, I would highly encourage the vendor to introduce the staff to the new owners and build connection with them. That's something, and then we will talk about the legal part. That's what I'm gonna suggest them to do.